Welcome back, you legends. I'm Dr. Ken. Let's get right into this video. I'm on vacation, guys. I'll be off for the rest of the week. I'll be back hopefully on Monday, next Monday. So I'll be missing all of this exciting hot stuff that's coming out in the next couple of days. But I love you all, and I had to get this video out. I'll try my best to get this done as quickly as possible. So let's get right into it. So the stock market today is down. S&P 500 down 1%, NASDAQ 1.9, about 1.9. Dow 0.7%, the different sectors. The laggards were cyclicals, communication services, and technology, as well as financials. So the riskier, the more risk on, the more growth-oriented parts of the stock market are down. And we are seeing defensive positioning into utilities, healthcare, real estate, and so on, right? Energy, basic materials, industrials, and consumer defensive closed somewhere in the middle. And again, we're seeing defensive posturing with utilities and healthcare leading. And we're seeing that high risk appetite abating a little bit as we're seeing those earnings weaken. I'll talk about the earnings. In fact, let's jump straight into the earnings. The S&P 500 jumped after hours today after Google, Microsoft, Visa, and Texas Instruments reported. So this was a massive jump in Microsoft, despite the fact that Microsoft revenues and profits missed, as well as Microsoft Azure, their cloud computing part of the business. So a significant slowing in growth. And then later, guys, the earnings call went underway, and their chief financial officer talked up forecast for the rest of the year. So that did calm down investor sentiment, and that drove the stock going this massive move up in the stock. So they're still forecasting strong growth for the rest of the year. So my personal view on this, guys, is that I bet that this stronger forecast will in fact come back to bite them in the ass. Okay, this was a bad move in my opinion. They should have warned. They should have talked down the forecast. They should not have calmed down investors. In fact, they should have baked in more of the bad news early on. So that gets baked into the expectations, and the expectations come down, not move up. So this was a bad move in my opinion. This means that expectations going into the Q3 and Q4 earnings will be higher. And that's a mistake in my opinion. Let's jump into Google. Google also missed on revenues as well as profits. Their ad revenue on YouTube also declined. So this was a negative quarter for Alphabet in terms of growth. Growth was slowing down. In fact, it was one of the slowest quarters perhaps in the last 5 to 6 years for Alphabet. But still, even after that miss on revenues and profit, Alphabet did move up. And that just goes to show how bullish the sentiment in the stock market is right now, that stocks are moving even on bad news. And this tends to happen around the bottoming process of the stock market. When the stock market starts to bottom, one of the signs is that companies will give you really bad earnings or bad forecasts, and the stocks will still move up. Texas Instruments actually beat on both earnings and revenue, and it did move up post-market, so this is good. Every single semiconductor stock so far, TSMC, NXPI, which has more exposure towards things like cars and the automotive industry. Now Texas Instruments, a company that has its tentacles all over the place. They sell basically to everybody in the economy. They did outperform this quarter, but remember they cut their forecast last quarter. Okay, they cut the forecast, and now they've beaten their older forecast. They cut the forecast by $500 million, and in fact they ended up beating by $500 million. So the way I'm looking at this is that semiconductors are still healthy so far. They're doing okay. Their business is not slowing down that much. Now let's jump into Visa. Visa reported today they beat on revenues and on EPS. The stock did shoot up after hours, but then it dipped after the earnings call when the company executives did warn about uncertainties into the future. So this was a good move in my opinion on the part of Visa to warn about uncertainties. That's the best way to go. You don't want to over promise and under deliver. You want to under promise and over deliver. Let's jump into the daily chart of the S&P 500. We're still trading within this bear flag, right? We had this massive bear flag going all the way back into the beginning of April, and now we've been ping-ponging inside of this bear flag. My expectation now that we've had some of these massive earnings out of the way, a lot of that uncertainty has been now priced out of the market, and my guess is that we will see another test of this high right here. My hope is that we overshoot this high, we close this gap, and at least hit the upper edge of this descending channel. My hope is that we hit about 406, 405 in the next couple of trading sessions. I'm very wary of Friday, okay? I'm bullish tomorrow, so Wednesday and Thursday, and I'll talk about why I'm bullish on Thursday and Wednesday and Thursday, but I'm bearish Friday, and it has to do with Apple's earnings coming in after hours on Thursday, as well as the fact that we will have the FOMC meeting out of the way tomorrow. So they will raise interest rates by 75 basis points. That is to be expected. That's not news. They did signal that they will raise by 75, and my guess is that they will meet those expectations. And when the Fed choreographs and moves and then does that move as the market expects, that's usually bullish. The market likes that. The market does not like uncertainty, okay? So this is good news. So far, we've had some bad earnings out of the way. That will get priced out of the market. That's good news for the bulls. And then tomorrow we will have some more earnings. Tomorrow, in fact, let's see what we will have. We'll have Facebook, and we will have Ford, Shopify, Qualcomm, and Lam Research. So Qualcomm and Lam are both semiconductor companies. Qualcomm is more into the mobile part of the semiconductor industry, so they provide chips for mobile phones. Lam Research is more about semiconductor equipment, so I expect Lam to do well. Qualcomm is a bit of a mix. We will see what happens with Qualcomm. If Qualcomm misses, or if Qualcomm warns on forecast, that will drag down Apple, right? Because that will give investors a read into the mobile phone market. Facebook, we will see what happens with Facebook. Will it miss like Snap, or will it provide less of a miss and more akin to something like Alphabet? Google, where the news was not as bad as feared. It was bad, but it was not as bad as feared. We will see. We'll see what happens with Ford as well. GM reported today, General Motors, and the stock did fall because they had challenges with the supply chain. So the revenues moved up, but their profit margins declined because of supply chain issues. My guess is that Ford will probably have the same issues, okay? Shopify is a bit of a mixed bag. We will see what happens with Shopify. It is trading at 200 times earnings, so that's insane. I don't like Shopify's valuation. It's absolutely out of whack. I'm not really interested in the stock at the moment. So on Thursday, after market close, we will have Apple and Amazon, the big kahunas, and we will see what happens. So why am I more bullish Wednesday, Thursday? I think as the market brushed off earnings today, they will brush off earnings tomorrow as well, and the market will move after the FOMC meeting is out of the way. That's my guess. I don't know for sure, but that's my guess. And then Thursday we'll see a move up as well, and then we might see some fear come back into the market after the market close when Apple and Amazon reports. And then on Friday we have massive economic data coming in and dropping, including the inflation data coming in, right? We have PCE inflation. PCE inflation is the preferred inflation measure by the Fed. We will also have consumer spending. We will also have employment costs, Chicago PMI, consumer sentiment, 5-year inflation expectations. So many economic events coming in on Friday, and they're big economic drops, okay? Now, in terms of GDP will come in negative. I'm willing to bet that GDP will come in around 1.5 percentage points down, and I think the market will probably shrug it off, okay? I'm no longer in the camp that this will crash the market. I'm now thinking more that the market will probably shrug it off, and they will talk it down. They will say, okay, the GDP is down not because of weak employment or weakness in the economy. They will say, okay, the GDP is down because we're importing a lot more than what we are exporting. So when imports are larger than exports, that eats into the GDP number. So my guess is that they will use that excuse. And we also have some political talking heads come on yesterday and over the past couple of days, talking about how 2 consecutively negative quarters are not what defines a recession, even though every single time in the last, 80, 90 years, when we had 2 quarters with consecutive negative GDP growth, that defined a recession. So now they're trying to change the definition of a recession, which is expected. That's sort of the games that they play, these political hacks. don't pay too much attention to that. Again, my hunch is that Friday will be bad, that Friday has a lot more risk than Thursday. Okay, we will have Apple earnings come out after the market close on Thursday, as well as Amazon, and then we have all of these economic figures coming out. If PCE comes in below expectations, boom, that's a big check mark for the stock market. We might see another leg up in the market if the inflation figures come in below expectations. If the inflation expectations also come in below expectations, that's good. If consumer sentiment starts to improve, that's good. If Chicago PMI comes in above expectations, I doubt that. I think the PMI will come below expectations because the market is slowing down. So we will see what happens. I always like to say that you want to wait and see and react. You don't want to predict when volatility is high. When you have economic events like this, you don't want to predict too much. You want to see what the market does and react to that, okay? For many reasons, because sometimes what ends up happening is that the economic figures come in exactly as you would expect them to, okay? But the reaction by the market is completely different to what you would expect, right? So we might see GDP coming in negative, and then we might see a rally in the market. That could happen because the market might be jumping ahead and thinking about the Fed cutting rates to support the economy, and then rallying on that, okay, on that assumption, which is a wrong assumption in my opinion. It is famously said that the market can remain illogical and nonsensical longer than you can remain solvent. So if you want to bet against the market, you want to make sure that the market is wrong at the moment, and then the market will change its view to your view, okay? So even if the market is wrong, you don't want to be betting against the market too much unless you are nearing an inflection point. Now let's get back into the chart. This is the triple Qs. We had a rejection right at 308. After those earnings are out, I do expect some bounce back into the triple Qs, a move up. We have this right here, this trend line. We might see a touch of this trend line, although I'm starting to doubt that. I think we might rally tomorrow and rally on Thursday as well. That's my read right now. We will see what happens. In terms of ratio charts, we have the triple Qs divided by the S&P 500. We are getting really close to another support line right here. My expectation is that even if we touch this line, we will see a bounce back and then get a final touch of the upper boundary, and then we sell off, okay? That's my expectation. We will see what happens on the VIX. The VIX did get into really dangerous territory here back on the 22nd, which was last Friday, right? Every single time we got down and touched the bottom edge of this ascending channel, we saw a massive spike in volatility and fear, and a massive sell-off in the stock market every single time. Right now, I do have these signals that I talked about that I have marked with these black lines right here. And I did notice that this probably was an early signal, and this is why. The signal basically, guys, is when the VIX puts in a low and then breaks that low on a second dip, forming a double bottom with a second lower low. Usually when this happens, the VIX shoots up. This happened right here. It happened right here. It happened as well right here. It happened here and here and so on. But sometimes what happens is that the second dip, example here, where we had a low right here breaking the previous lows, we did not have a jump in the VIX straight up. We had some more downside in the VIX lasting about a week and a half, and then we had the proper signal right here. And what marks the proper signal, guys, is right here in the momentum. You start seeing the momentum start to move up, right? Every single time where we bottomed on the VIX and bottomed on momentum and started to see momentum move up, we had this massive jump in momentum, right? This is the same thing. Momentum bottomed right here and started moving up. Momentum bottomed right there, started moving up, and then momentum bottomed right here and started moving up. Momentum did not bottom on this last signal, but it has bottomed now right here. Momentum has bottomed. My guess is that momentum will start to curl up, continue to curl up as the VIX calms down again and does a second test of the lows, okay? That's what usually happens, right? You make a low right here, and then you undercut it, and then you move. You make a low right here, you undercut it, and then you move up, okay? So that's my expectation now. I am expecting the momentum to the momentum of the volatility to continue to go up as the price or as the reading on the VIX goes down, okay? So what would drop this volatility down is this, guys, okay? As the FOMC meeting is concluded, as the announcement is made, a lot of hedging, a lot of premium on options, on put options, which are insurance contracts. If you're not familiar with options, they're insurance contracts that protect you against downside in the market. So when uncertainty is out of the way, prices and options go down. That drives the VIX down. Okay, so when that event is concluded, the volatility usually drops down. That's when we get the second touch, and that's when probably we will see the S&P 500 put in one last high before moving down. Same thing with the triple Qs here, guys. So my guess is that tomorrow, Wednesday, we move up, and then Thursday we move up again. And then Friday we start moving down. We start that proper sell-off. Let's take a look at Apple. Apple has played out beautifully. It has been trading within this descending channel that I've drawn up absolutely beautifully. Right, we've been ping-ponging up, down, down, up, down, up, down, up, down, up. Every single time we touched the edge of this channel, we actually had a reversal. So when we touch the bottom, we move up. When we touch the top, we move down. Makes sense, right? So now we have touched the upper edge. We've now moved down. We'll probably see a small rally in Apple Wednesday, Thursday, right before the earnings, right? We might see another touch. And then after the earnings, we might see Apple show some weakness. And that's probably the best time to load up on options. When earnings are out of the way, options are much cheaper. Implied volatility gets priced out of the option chain. You can buy puts a lot cheaper, and that means greater profits if Apple ends up moving down. And I do expect Apple to at least go back down and touch this red line. And what this red line signifies, guys, is bullishness above it and bearishness below it. So if we start talking about the stock market bottoming, we need to see things like Apple, stocks like Apple, show some bullishness, and bullishness in Apple would mean that we never break below this red line, and even if we do break below, we move back above it really quickly. Okay, so it would be a false break. I also want to quickly say, guys, that if you like this content, if you would like to support me, you can do that by joining my Discord group. It's a way for you guys to support me if you'd like to do that and be part of the community as well. I post all of my trades there, my trade ideas, charts, all that good stuff in the group. We also discuss what's happening in the market, earnings, strategies, all of that good stuff. So if you want to support me, remember, guys, I don't make any money out of these videos. I make $0 out of these videos. So if you want to support me, that's one way you could do that. If you'd like that. Another way, of course, is to subscribe, comment, like. You can support me in that way as well. Thank you so much, and I just wanted to mention that really quickly. Let's go into Microsoft. Microsoft has been trading within this range. It's been moving sideways for months now, since May. So this was and has been a terrible trade so far. Now I do expect Microsoft to move back up after those earnings are out of the way. I would not be an investor. I don't like the valuation on Microsoft. It's at 26. That's insane. A 26 PE on Microsoft, a massive company like this with slowing growth. Boom, I don't like it. Now let's talk about Google. Google actually had a false break today and again moved to the upside. This always happens, guys. When you see the market move down ahead of earnings, it tends to move up after earnings. When the market moves up ahead of earnings, it tends to move down after earnings. That's what tends to happen. Earnings tend to be a pivotal point, right? If you move down, you tend to reverse after, and then if you move up, you tend to reverse to the downside after that. So makes perfect sense. I expect Google to move up again, maybe at least go back to the middle of the range. We will see what happens there. If we get a rejection right around here at the $115, and we get a rejection and we sell off, that would be super bearish. Let's jump into AMC. AMC has been selling off ever since that stock split on GME concluded. We have now officially crossed down to bearish territory on the momentum. I don't like AMC, guys. I don't like it as an investment. I don't like it as a trade. As an investment, there's nothing to invest into here. There are so many better companies to put your money into. I don't like these meme stocks. The options are so expensive. It makes them untradeable. But I do bring them up because I know a lot of you guys are interested in them. But I'm not a financial advisor, but I would not invest in these, okay? Same thing on GME here, guys. We had this reversal right after that split came in. We might see a bounce back up. It's possible we might see that. But again, remember, guys, what I said in the last video. Stocks, high growth stocks tend to top first and then bottom first as well. And we're now seeing a somewhat of a topping process in the short term and a bottoming process in the medium term. What I mean by that is this. We are now seeing a topping process in the short term, and what I mean by that is this. This is a short term trade, right? We are now seeing some topping here. And what I mean by a bottoming process in the medium term is that when we pull back, and we will pull back, we will sell off. When we do that, we might start to see this low on the triple Qs hold. And if that does end up happening, that will probably signal a bottom, a mid-term bottom, medium-term bottom, where we rally into November, December, and then maybe start to sell off into March of next year, okay? Same thing on the SPY. We are now seeing some topping in the short term and then a bottoming process probably in the medium term. In fact, I do expect that the S&P 500 will hit this pivot zone that I have right here at $350 right around the next Fed meeting in September, on the 22nd of September. And in fact, again, guys, if you look at this descending line, this red line right here, this line acted as resistance, resistance, resistance. And once we broke through that line, it might start acting as support. And by that, I mean that even if we see a sell-off into September, we might see a bounce off of this trend line, and then a final bounce right here, or a final low on the next Fed meeting on the 22nd. That would bring us down to $350 just about. That would make perfect sense, because that would mean that we touch the 200 weekly moving average, and the 200 weekly moving average has acted as a massive pivot point in the last 10 to 20 years, right? We tend to touch the 200 weekly moving average and then bounce. Sometimes we undercut it, but then we bounce again. This happens all the time. We get really close, we bounce, we touch it, we bounce, right? So a lot of investors will be piling into the stock market once we see a touch of this 200 weekly moving average. After that, my expectation is that the stock market will start again to move up into November, December, possibly into January. And then my expectation is that around March, we will see a violent crash in the market again, as all of these delusions that we will see a shallow recession, we will the economy is strong, consumer is strong, whatever, blah 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 blah. All of that is just bullshit in my opinion. We'll probably see the stock market realize that it's all BS and then start crashing again around January, February, March. A lot of people would call the bottom right here, and that might be true in the medium term, but long term, this is not the bottom in my opinion. We'll probably see a pivot back to the upside. We might see the market hit 400 and even go above that and hit this trend line, this long-term trend line, and then get a resistance and get really strong resistance around 460. We might even overshoot, put in another high, right? So like that, we move up, a V-shaped recovery, everybody's happy. Oh, the recession is over, everything is great, blah, blah, blah. And then boom, we see the proper crash. Why do I say that? I'm not pulling that out of my behind. It's because of this, guys. This is the Treasury yield curve. This is the 2-year divided by the 10-year, 2-year yield divided by the 10-year yield, and it has inverted, and it has inverted very, very deeply. This is a much deeper inversion than what we had back in March. And remember, guys, every single time this yield curve has inverted, where the yields on the 10-year treasuries are lower than the 2-year treasuries. That's a lot of jargon. It basically means that bond traders are selling the short-term bonds and they're buying the long-term bonds. And it tends to be a really early signal ahead of the recession. The lead time tends to be 6 to about 18 months. So half a year into a year and a half, we tend to have a recession, like a proper deep recession. And this yield inversion is one of the deepest that we have ever seen. This is like a super deep yield inversion. The last time we had inversion this bad was back in 2000, right before that massive crash, that massive internet bubble burst, this prolonged 3-year bear market that we had. This is an inversion that's as deep as that. So it's predicting a pretty bad recession. So after the yields invert, we tend to spend about 6 months to about a year and a half before the market crashes, before the economy crashes. And the better way to time it is when the yield curve, after it inverts, it moves back up and it starts to steepen. When you see the steepening in the yield curve, that's usually around when the market starts to crash. Okay, the yield curve steepened a lot. Look at that, into February, March of 2008, and then we had that massive stock market crash in the middle of 2008 and into November of 2008. So again, in terms of timing all of this, my expectations, and these expectations could change really quickly depending on what happens with the economy, but my expectation is that the yield curve will start to steepen around Feb, maybe March of next year, and that's when we will see the proper crash, the real crash, not this slow grind down that we've seen so far in the market, but a sudden violent move where something will break, companies will go bankrupt, investment firms will go bankrupt, things will go bad. Okay, and that's pretty much all I have for you today, guys. Thank you so much for watching, supporting, liking, subscribing. I love you all, and I'll catch you on the next one, probably around Monday, maybe Monday, next Monday. Thank you again, and bye-bye.
Oh, wow.